My name is Ivan. I live in Los Angeles, and I commute between Los Angeles, San Francisco, London, and Jersey. And what I do is I do early stage investing, and I raise capital, and I sell technology companies predominantly around software, digital media, internet, mobile, anything with bits and bytes. So nothing like semiconductors, pharma, things like that. The reason I got into this business, by the way, how does this work?
Just press it.
There we go. The reason I got into this business is for a long time I was the CEO of a number of different tech companies in Europe and in the US. And as a CEO, I did a lot of M&A work, and I raised a lot of money. In one instance, $130 million for one company. And I noticed that the advisors typically didn't have domain expertise. And as you all know, in the tech sector, in absence of domain expertise, you cannot really position the asset properly for the buyer, and nor will be able to understand fully where the asset is in the life cycle of its valuation. And that's exactly what we're going to talk about today. I actually do teach this class at the USC Marshall School of Business, so imagine those poor kids that have to listen to me on a regular basis. And I'm very, very involved in the community in all aspects. A few things this evening. I tend to speak quickly. If it is uncomfortable for you, please stop me. If I use any terminology you're not familiar with, please ask. And this conversation is much better had as a discussion versus a one-way conversation. So if there's anything you want to ask, just stop, interrupt, and please go ahead and turn it into a discussion. So with that said, this is the reason I put up the portfolio companies. I wanted to give you an idea as to what are the types of companies we're involved in. First and foremost, they are focused in our Los Angeles office. We have about 85 portfolio companies. We are also, as a matter of strategic investment, have invested in the leading incubators, accelerators, and seed funds around the world. So again, the reason becomes very clear as we discuss. If you think about it, if you have the data around where early stage money is going into tech, and then if you have regular conversations with buyers as to what they're looking for and how much they're paying for them, you will gain an understanding as to where the market is moving towards. Does that make sense? Because again, that's the core of the conversation we're about to have. Most tech companies have a very predetermined valuation trend. It is not like a property that the comp next door will tell you what's going on. They go through trends that are somewhat determined. For example, ad tech companies 6 years ago sold for 6 times revenues. They currently sell at 4 times EBITDA. That is a huge diminishing return. Once the first sectors sell, the rest of them become commoditized. But how do you know where you're on that cycle? That's the core of the thesis. So if you have a number of these companies, for example, Science is an incubator, 500 Startup is incubator. If you look at incubators and really high-end seed stage funds, for example, at Amplify, which is one of the leading ones, we look at 1,000 early stage companies to take in 30. And I was just telling a colleague earlier today, I can close my eyes and pick any of those 30 and know they have a very high degree of probability of success, because we pick them not based on their ideas, but based on the quality of the teams, purely. Ideas are a dime a dozen, IP has no shelf life, and the only thing that we invest in is the kids. Now, how do you pick good kids? Any thoughts? Unfortunately, I don't have any thoughts either. I'll share with you. The other thing is, as the companies grow, we almost always co-invest with other players. There's 2 reasons for that. Number one is risk mitigation. So as the checks get bigger and bigger, you want to be able to call these guys and say, do you know this team? What do you think about them? Have you invested in a similar strategy before? What do you think? And you also want them to do the same thing for you later on. So it becomes deal sourcing and risk mitigation, and most importantly, validation of the team and the business model. For example, The example that I've used multiple times this week is as recently as 4 years ago, there was no e-commerce in Los Angeles. None whatsoever. And a very close friend of mine by the name of Brian Lee. Does anybody here know LegalZoom? Has anybody ever heard of LegalZoom? It's the largest online legal document repository in the world. And it's doing like almost $200 million a year in revenue right now. He was the founder of that, and he went off and did a company called ShoeDazzle. Now, believe it or not, this was news to me. Women like shoes. They decided that women like shoes so much, they're willing to buy shoes on a subscription basis. Now, to the average man, this sounds mad. You want to buy a subscription to receive shoes every month? The answer was yes. The company went from here to God knows how many numbers very, very quickly. Women signed up to receive shoes on a subscription basis. Interesting. So what happens immediately? A number of other people immediately copied the idea. Copied it literally to the T. So the first one that goes out, if he's someone with a track record, attracts money. So he was able to raise, I was actually there, we raised like, I don't know, 6.5, 7 million initial funding. The next one that went out was one of the ex-co-founders of MySpace. How much funding does he get? A lot more than that. So after the first one goes out, if it's a good idea, it's no longer an idea. It's a question of execution. Who is going to execute better? A bunch of years later, even though I had a very large offer for Brian to sell and he was stupid enough not to, he didn't execute well. And the second one out, which is called JustFab, acquired the first one in a distress sale about a month ago for less than a third of the capital raised, and for less than a tenth of the offer I had for him a year earlier. So the reason I bring it up is it's not all sad news, because once he started, others copied. Within less than 3.5 years, we had almost 60 e-commerce companies in Los Angeles selling everything from razor blades, which is called $1 a Day Shave Club, to dog supplies, to flowers, to wine, and just whatever else you could possibly imagine, and believe it or not, women hygiene. Everything that you could possibly just brand and sell on a subscription on a regular basis. Coffee for offices, and so on and so forth. So several people from the companies that were started, in particular, and this is a very common thing in Los Angeles, once a majority of their options were vested, immediately went off and did the other things. You're all familiar with how options vest in the US, right? It's a 4-year vesting period. So, and they accelerate upon some transaction. So, and even with ShoeDazzle, several of the senior executives, even though it was going down, went off and started other companies. So the net effect of it was now Los Angeles is really the center of e-commerce in the United States. And the talent we have, one of the companies that we have is called Science. In Science alone, we have almost 22 e-commerce companies. And they're all world-class. So far, so good? By the way, is somebody managing time here so they can kind of give me the... All right. This actually looks... So let's talk about the life cycle, because as anyone that I've spoken to over the past few months knows, this is the slide that I go back to over and over and over again. So if you break up the tech life cycle very simply, it kind of breaks down into this. So first, somebody has to seed a company. And generally speaking, we are not talking about a guy and his friend and a dog in a garage or something like that. It's a little bit more material than that. They have an idea, or they're copying an idea, they have a good team, they want to put something together. Seed stage is small amounts of money. They want to get something off ground. From seed, by the way, generally speaking, at seed stage, accelerators come into play, the early stage guys come into play. And generally, it's about demonstrating the ability to take it to the next level. And I repeat that because I want to make sure you understand. Here, we are not talking about $1 billion idea. Our goal is to get here. There's a big difference there because of a number of reasons. Yeah?
Sorry, could you just explain what an accelerator is?
An accelerator is a shop. So there's a difference between an incubator and an accelerator. And generally, the difference is which one is going to rape you more. So accelerator retains a vast majority of the ownership and the equity of the company that they're incubating, whereas an incubator is more reasonable about it. For example, at Science, they own on average over 70% of every company that they're accelerating. And you can come here with a good team, with a great idea, and we say, you know what? Your idea really sucks because we tried it last year, it didn't work, but we like you and your team, come and do this one for us. And we also have a core team of experts in customer acquisition, in recruiting, in doing, for example, in the e-commerce sector, this, that, the other, and we'll help you get off ground. And we're going to give you 3 months to do it, and we're going to guide you through it. If it's done properly, it is a phenomenal thing to do. But it has a core team with special expertise in areas to guide the younger teams to get to the next level. With an incubator, it's a little bit more hands-off. You get a little bit of guidance in that, but not like that. But you also, the entrepreneurs own the majority of the company. We're good?
Can I ask you, when you come from kind of West Coast and you talk about seed,
yeah.
A lot of the UK and or European, wouldn't you say there's a difference in the amount of money that's talked about on the round? Because most things that we would talk about is sub 1 million valuation. So it's, you know, and you said in an incubator, and somebody comes with an idea, in the dot-com boom stuff, you know, people were throwing several million at just ideas, etc. What kind of level are you seeing that valuations where, as you said, an incubator would take 30-40% of the business, and what seed capital would they give for that?
It's so funny you brought that up. At the summit we just had, and a few of your colleagues were there were 2 people there that were very interesting. One was Bill Gross. Bill Gross was the one that started Idea Lab. And his idea initially was, we're going to put $250,000 in a company. Once we have helped them with the money and the guidance and this and that, if they are unable to get to the next level themselves, they're out. We are back to that. At the same time he had it, John Saw, who is now running LegalZoom, was there, and he said it. At the bubble, a 29-year-old with simply a PowerPoint raised $29 million without a team. That's not happening anymore. But we do have a bubble because Snapchat is getting over $1 billion valuation, and they can't even monetize yet. So bubbles happen all the time, whatever you do about it. But for the most part, there is people seem to be somewhat rational. They get hyped up every now and then. But currently, we are back to the model of it is very efficient to set up a company right now. If you cannot really set up a company for $250,000, you shouldn't be in the business. In particular, because the accelerators and incubators provide you with a package, which we've discussed actually internally as well, of legal, financial, bank services that are very, very low cost. Are we talking a few $1,000s at best, as well as $10,000 of Amazon Web Services and free software and this and that. So your initial upfront costs are very, very minimal, which means you can focus purely on developing the idea to demonstrate whether it will actually work or not. So typically speaking, Microlabs does 50, Amplify does 100. It's somewhere between 50 to 250. But if you cannot take it to the next level there, you're out. Does that answer the question?
Good.
So you go to early stage. Generally speaking here, it's either 2 or maybe 3 people. It's never 1, ever. In fact, we've had people that say, oh, you know, I don't want to have a team yet. Immediately kick them out of your office. You need 2 people. Typically a CEO or CEO-to-be and a CTO. One person is responsible for clearly articulating how the business will be monetized and what the business model is. The other person is responsible for implementing it from a technical standpoint. The rest will follow. Once you graduate from here, you might have a third who's a developer, but you can outsource it and so on and so forth. But once you get here, if we're interested in putting in the money, the first thing we want to do is build the team. And you will find the recurring theme that we'll talk about. It's all about the team every step of the way. So here, we put in the team. There's another interesting thing that happens here. How many of you guys are familiar with like Silicon Valley Bank or something like that? All right. In the US, once a good venture fund or a private equity comes in, I can bring in venture debt too, which is practically free money. And it's usually between 20 to 33% of the round in debt. The important part of it is, let's say you're raising, I'll use the terms, if you don't understand, tell me. Let's say you're raising 5 on 10. That's a 30% dilution. But if I can supplement that 5 with another like 1.5 in debt, I'm extending my runway without any dilution whatsoever. It's a huge thing both for the investors and the entrepreneurs. So that's what happens at this stage. From here, by the way, everybody asks what's the timelines. Typically speaking, here until the money runs out, here until the money runs out. So there's 2 ways incubators do it. Either in a class-based, so there's a specific start date and a graduation date, which is called demo days, and they invite all the investors, and the investors come and go look at all the companies that are incubated and decide which ones they're interested in, that they start negotiating. Or like what we do in Amplify is there's no start or start. You come in, take the time you need. The money is fixed. Whatever you do with it and how long it takes is your business. So either way works. The demo days have, I don't like demo days personally because I don't like the VCs to meet the entrepreneurs for the first time there and then. I think it's a relationship to be built. I think they need to come and visit them over and over again. And when you're competing for other VCs at the same time, it just takes away from that relationship building. So I believe in not doing it that way. Once you're here, the expectations are higher. For example, an ad tech company or a mobile company, your revenue model, the expectations for growth are very high. We are not talking 10, 20% a year. We're talking doubling or tripling a year. And the expectations for the team are very, very high as well. And the growth part, what we're going to speak about at length, when you go from here to here, it could actually happen very, very quickly, is the moment you have a really good team, and I promise you guys like me are looking left and right to find good teams. And the moment you can show traction, and there's a few other things, I have a slide just on that, you're going to see that money will come to you. There is an enormous amount of capital available, but for very few teams. Most of it is concentrated in Silicon Valley. Outside of Silicon Valley, this money is a lot less available, which is why, as we raise money for companies, oftentimes the investors say, we like that company, but you're going to have to move them here. I'm doing 2 of those right now, one out of Spain, one out of London. It's unfortunate because if you think about it, those are the best companies, which is why they're being funded. That means they have the best teams. If they're going there, they're being funded properly, but at lower valuations, but they're probably going to get an exit, which means everyone involved in that company will be funded in Silicon Valley for their next companies, which means wherever they came from just lost a very big chunk of their ecosystem. This is why that gravity of Silicon Valley is sucking up so much, both from Los Angeles and a lot of other areas, because that's the only place where growth capital is. And only the best companies get it. That means the best teams get it, and they stay there. And usually when you sell a company, the senior team is immediately funded to start their next company, which means wherever they came from just suffered a major loss. I want you to remember that. This is the biggest problem in a lot of communities, in particular Los Angeles. So from there, we go to late stage. Late stage is where most of the money is. Why? Because they want to be the last money in before the exit. Risk mitigation, I don't want to make 10x, I want to make 2x, but I want to make it next year. These are guys like IVP that just put in a sick amount of money in a company that doesn't even make any revenues, but somehow they manage to do it. Late stage is very competitive, but the check sizes are $80, $100, $200 million sizes. It is highly risky, but you have to have massive funds to do it. And of course, we go to liquidation events, which currently is limited. The IPO markets, we'll see how Twitter comes out. The IPO markets are very shaky. I'll use an example which I can. Again, I'll use LegalZoom because John happens to be one of my very close friends and we can disclose it. He was going public, and this is a company that's been around for a long time, at the time was doing 140 million rev, significant EBITDA, growing steadily over the years. Morgan Stanley was taking him out. The week he was going to go public, 4 companies, SaaS companies and companies in the sectors that were publicly traded, had their earning calls, and they were all below expectations. So all 4 of them declined between 20 to 40%. They had to pull it. They didn't do anything wrong, and the market overall wasn't really collapsing, but his sector got hit so hard that they had to pull the IPO. And it happens a lot. So it doesn't matter if your company's solid. It doesn't matter if the market overall is this and that. You have to hit the right windows, and the windows are somewhat narrow. So the IPO markets are not very good. So how do you get money out? M&A, you could sell the company, which is incredibly important to understand when you sell the company versus waiting for inbound interest. But the one that's more popular right now is secondaries. So you can actually go to one of the late guys and say, we want to do a majority recap. You know, I'll sell 75% of the company, I'll keep 25%, but I want to cash out. There is a lot of checks being written like that. You guys are familiar with secondaries, correct? So, and the goal is, once there is an exit of any kind, they come out and, of course, start a whole bunch of companies, hopefully in the same geography or wherever they can, and off we go, and the cycle continues. By the way, the other thing that we're finding is here, there's a lot of, and we're going to talk a lot more about growth, but there's a lot more availability for entrepreneurs to take money off the table. Like 10 years ago, it was unspoken. Now it's very normal. So you're raising a $20 million round, the founding team can take 2, 3, 4 off. Very, very normal, because the IPO markets are not there. We're going to expect them to work harder, longer to get to an exit, but let them live properly for that period. So far, so good? Okay, no. Ha. Yeah.
I missed it, but what I find interesting is the absence of a term in your life cycle, and that is maybe because it's more European, but the term business plan.
Who cares?
Discipline of sticking to the business plan, particularly in the early stage.
To be honest with you, the business plan is secondary to the team. I look at business plans all the time, and I punch holes in them all the time. Most of them are meaningless. I have never seen one that materialized. But I ask questions about them all the time. I met a young lady the other day, and she was running an e-commerce company. I've been telling everybody. I asked her 5 questions that I ask all e-commerce companies. Most of them don't even know what the terms mean. So that business plan to me is completely meaningless. Their ability to answer my questions about the business plan is really what matters. The numbers that they give me are all, everybody has a hockey stick. I'm like, I've never seen a hockey stick. So no, it really is not important. So when we first do this, that comes later. First of all, in the seed stage. I mean, there is no budget. No, not at all.
You can make that money stretch to the next milestone.
If they don't, they're out. Don't forget, I mean, if they are in with us, or with the people that are invested in, they're getting access to incredible resources. And I assure you, during our conversation, we go through details about how exactly they plan on pissing away that money. So it's unlikely that they're unclear about exactly what my intentions are. So they know exactly what they need to do. And if they don't, they're out, which is one of the critical points of being an investor. If they are not doing their job, unwilling to pivot, or unable to pivot, you replace them or close them down. If you're unable to do that, you're going to be... Pivot means you have a business model that is not working. And I come to you and say, you're selling shoes online for $40. Your gross margin is about 35%, so you're making about $10 per shoe. Your customer acquisition cost is about $160. Your average customer is buying 4 pairs of shoes a year, and typically they're a customer for 2 years. So you're making about $80 per customer, but it's costing you $160. That doesn't seem right. We need to change the model. We'll make it in scale. No, the math doesn't work now. It will never work. You need to change your model. No, please go, and here's the door. Literally, I've had that conversation. So we go to that depth of, I mean, it's not brain surgery to break down a business model if you've done it a whole bunch of times. But the expectation is that they understand your needs, and we have these conversations very regularly, even with much larger companies, significantly larger companies. The problem is either the entrepreneur the CEO in particular, or one of the key VCs falls in love with the idea, you're screwed. Because there's no power on the planet that can explain to them that they're going to go down a track. So I have one live one. They came to me 4 years ago, and at the time, the investor behind it had put in 25 million into the company. I kid you not, I am not making this up. The CEO was a pretty good guy, but he knew what the hell he was doing. He asked my opinion. I said, he's a good guy, but he has no clue what he's doing. This business is never going to have revenues. Of course, the CEO had a hockey stick, and every month the hockey stick moved to the right. Now he's 50 million in, and he's still showing that hockey stick moving to the right. But the investor cannot bring himself to stop investing, because what if I can get my money back? You would be shocked how often we see that. So the discipline of investing is either get rid of the guy or get rid of the company. Otherwise, you're going to be pissing away the money. And you have a fiduciary duty to your investors and LPs to maximize their returns. Does that answer your question, Ina?
Do you issue all of your people with a lean startup, or should you?
No.
No, the book, the lean.
No, I know exactly the book. It's a very, very good book. But you have to understand, most people can't read. I mean, they're ADD, and if they're not ADD, they're chasing girls or drinking. So there's no time for reading a book. What I want them to do is build their interpersonal skills to attract good teams. And they all come to me and say, how can I attract a good team if I don't have money? I said, how do you expect me to give you money if you can't attract a good team? If you are unable to get someone to follow you, you don't deserve money. So the main thing I want from them is very strong interpersonal skills to put the best team together and the ability to change that team if they have to. Most people can't. But he's my friend. I know.
Ivan, you mentioned kids and chasing girls and drinking.
Great lifestyle if you can have it.
Is there an age limit? Do you look at people coming through the door at, I don't know, 35 and say, too old, buddy?
Not at all, actually. There is such thing as too young. Like there's this girl in Los Angeles that is really popular because she goes around and she's 21, 22, really, really pretty girl, and her company's going to go down in flames. I mean, she came to me for funding, and on the surface it looked good. When I broke down the business model, I asked her 5 questions that I usually do. Blah, 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 blah. How about dinner? I'm like, no, this doesn't make sense. She did manage to raise her money, but she spends her time flying around with people, things like that. So there is such thing as too young, but too old, no. But you do want, you want 2 things. If someone is older, you want to know that they can bring the team with them. Bring the team with them. If there's someone who's 35, 40 to do it, I fully expect that he's walking in the door with me with his 2 key guys. If they're younger, I expect them to find them. If they're at that stage, I want them to know them, have already talked to them, and bring them to the table. So no, actually, we even have guys at Science that go in, they're in the mid-30s. They've already been senior executives at other companies. They still go to Science because they know they will learn there. And it's an ever-changing industry, too. I mean, the models change so rapidly. So you need to be able to learn that quickly, too. It's sector focused. So, for example, around e-commerce. E-commerce would be gross margin, plus CAC, which is your customer acquisition cost, frequency of purchase per year. If you take inventory, what are your return policies, what's your freight costs, and I'm missing a couple of things. For example, in the subscription model, it would be similar things, but churn becomes an incredibly important number. In online ad, the questions will be, are you premium or are you long tail, and are you affiliate or direct on the other end? So it's not brain surgery. You go through them, you get it. But if they don't have numbers, and if they have to think, they haven't done their work. That means they don't know what the hell they're doing. If they have numbers, you can talk. But it's very sector specific. By the way, I am a judge at a lot of these VC panels and conferences where we have these competition with all these people come and pitch their ideas and all of that. I'm like the worst judge ever because I'm like, that's the stupidest idea I've ever heard. Okay, so here we're just looking at the size of the investment. So currently speaking, if you look at what's going on around the world, for the most part, there's a lot of money here. Up to about $2-3 million, there's plenty of capital. And if you're half bright team, you should be able to raise that kind of money. And there is a lot of money here. Between 3, 4, 5, and 20, 25 million, it's much more difficult to get money. And that's been a more recent development because most funds have decided to go to the two ends of the spectrum because risk is mitigated there. So that's basically the check sizes.
There seems to be a bit of growth in like crowdsourced funding.
Yeah, I'm highly against it.
So I just wondered what your views were on it.
Yeah. The reason is, look, if you have two investors, you have two headaches to deal with. When you're doing crowdfunding, you know how many headaches? Also, it causes a very weird cap table. One of the biggest issues in selling a company is misalignment of shareholders. So as a company grows, when they're trying to raise money, they sometimes, especially if they're raising money under duress, stress, they offer different preferences to different shareholders. You guys know how preferences work. So if you have 2x participating preference or 3x that means when you convert to common, the number of shares allocated to you before they go to the rest of the commons is so many. Which means if the company's current market value really is 100 million and you get an offer for 120, it may not be sufficient to meet the needs of all the shareholders. So they're going to say no at the board level. I have personally had that happen. $160 million offer for a company that was worthless. The shareholders said no. It went down and it shut down. It sold for $1 to AOL. So I don't like misalignment of objectives when it comes to shareholders. I want them all to be in the same shoes. So when you have too many shareholders, also US can be litigious with shareholder lawsuits and all of that. So the other thing is, if indeed you have to go to crowdsourcing, that means you were unable to convince someone to give you the money to begin with. So, all right. Growth capital. So far, so good. Now we're going to discuss specifically raising growth capital. We're good? All right. First of all, growth capital is sector specific. And for most investors, they focus on specific geographies as well as check sizes. So when you want to raise money, the questions that you have to ask is, when you're going to the money, number one, do they write the check size that I have in mind? 2, do they have any dry powder? You guys know what dry powder is? Number 3, do they have any competing assets on their portfolio? Dry powder means cash. By the way, there is no wet powder in case you're wondering. Dry powder, check size, do they have any competing assets on portfolio? 4, are they looking for any tuck-ins? Number 5, do they invest in my geography? And if those questions are answered, then you can actually have a conversation. The worst thing to do is to call upon them without that knowledge because you will not look smart, and that is bad for everybody involved, and they will never take your call again. If all of that is met, you can have a very good conversation, and the good ones will say yes or no based on very specific parameters, whether you're too early to try. We're going to go through the parameters in detail. So the reason I wrote this is because when you are going for growth stage, selecting your financial sponsor is more important than selecting your wife because they will make all the difference in the world in the rest of the life cycle of that company. It is an incredibly important decision. The good ones can play an incredibly positive roles, and the bad ones will make you miserable like you could not imagine. I have a company that we were trying to sell, and they have a private equity on the board who unfortunately, let's just say, whose opinion of himself is much higher than other people's. And he really actually thinks he knows what he's talking about, but he doesn't. He's actually really ruining that company. And you see that from time to time. But then you have guys like at Spectrum or Summit or InvestCorp that are absolutely engaged with the CEO. They have a long-term approach. They understand the bumps on the road. They know that you're going to need more capital automatically, and they're not going to hit you over the head. That is what you want, because they will be proactive. They will help you with the exits. They have domain expertise. They understand the numbers. That's what you want. Very difficult to get, sadly, but the difference is massive. Imagine having an investor on your team who does not understand not only your company, but your sector. That becomes very, very difficult. So, as I said, oftentimes we try to syndicate for a number of reasons. The reason I like it most is because when I call one of my friends, the first question is, do you know these guys? What do you think? It's validation of the team. The second thing is, what do you think of this business? Have you invested in one before? What else? Do you have any other intelligence we can share? And then they'll do the same with us. Number two is debt. Again, at this stage, imagine, I'll use AdKnowledge again. AdKnowledge is one of the leading online ad tech companies. They have grown pretty dramatically. They were able to take out a $100 million line of debt at, let's just say, a very, very low rate 3 years ago to give dividends to the two co-founders. So the ability to bring debt at very large sums when you have the private equity groups in and you're doing well is very much there. You cannot underestimate the power of that debt. I'm helping a company in Holland and they're doing acquisitions. Instead of using their own cash or their stock, we can do it with debt. Debt in the right hands used properly is a phenomenal instrument. It is becoming more popular here in the US. It's much more available. There's a lot more competition. But it's essentially free money. When you're looking at sub 5% money, it's essentially free money for a company that's growing 100% or 50% a year. Because your return on equity is so high, that 5% doesn't even put a dent into it. So please think about it. One of the things we would love to do, obviously, get Silicon Valley Bank on the island to allow our companies here to do that as well. That would be part of our goal. But they are one of the biggest players. They are B of A, and I think there's Square One or a few others.
If I may, just on the debt, what do they start up growing companies? What are they securing that debt against?
For the seed stage companies, the only way you will get it, believe it or not, is if someone the bank knows says, let's back these guys. If you call them cold, you won't get it. Because there is nothing to secure it. It is not secured. There's no personal guarantee. It's not against your AR. It's venture debt. It's a check, and we hope you will give it back to us one day. There is nothing secured against it. You get on top of that your AR. It is unlikely that anybody will come in absence of a financial sponsor. So it's almost always when the financial sponsor comes in, the debt comes in. You may be able to get your AR line, things like that for a little bit, but the real money comes in with private equity or. So far, so good?
You mentioned before that ratio. If you're at a stage where you're looking at a 20 million acquisition.
Acquisition or raise?
Well, you want to raise the debt to acquire effectively a competitor.
Yes.
So this is an actual situation.
Yes.
And so the amount of ratio that you said, because
no, that was on a raise, not acquisition. Acquisition financing is different than a cap raise. The parameters are different. The fees and the costs are the same, but the parameters are different.
Okay.
Because acquisition financing has to do with the price of the acquired entity, their EBITDA, the assets, and so on. As I'm actually helping with a friend that we are borrowing 86% of the acquisition price at less than 3%, no fees. They're buying it for free. So it has to do with the target as much as it has to do with you. So there's two ways to do it. If you have high EBITDA, you can have the debt instrument in place and then go acquire the company regardless of their assets or EBITDA. If you don't have it in place and your EBITDA does not justify that line, you have to use the target to raise the debt. Or if your company is doing very well and you're raising a growth fund, you get the debt on top of that, then acquire company, and then you do a recap, take money out, and pay everybody back. Those are the three scenarios. We're good? Everybody understood that? All right. That's self-explanatory. All right. So here's actually, this is, by the way, what I repeat over and over again. So when it comes to money, this is literally the order we go by. Who's on your team? And if that question isn't answered properly, we won't even get to the rest of it. Traction. So traction has different meanings for different companies. I'll use software companies, for example, because a lot of you are familiar with it. Enterprise software, for example, which is my personal background. Enterprise software traction means you have several, let's say 4 to 8, brand name clients that use the product in production for a mission critical application and have paid for it and are referenceable. And all of those criteria might be met, because I don't want you to get your cousin to use it and say no. The company has bought it, using it in production for mission critical application and is referenceable and has paid for it. That's traction. And if it happens to be a financial institution, it is 10 times better. Why? Because the CIOs of financial institutions have a significantly higher bar for acquiring new technology. So if you have a Merrill Lynch or a B of A or a Deutsche Bank buying your software, I'm good. So that's traction. Target market. I actually had a guy show a business plan. Well, actually, we don't have time. So it's explanatory. I don't want to use examples. Target market is how big. Right now, you're doing 20, 30, 40 million a year. Can we do $1 billion? Does your addressable target market support $1 billion business? Are there adjacent markets to it that we can go? For example, JustFab is an e-commerce company. I don't want to disclose numbers, but the way they're going about it is first it was fashion for women. Now they're doing fashion for children. Now they're going international. And now they're adding addressable target markets to it. Their goal is to do $2 billion. We're clear on the addressable target market. Believe it or not, the addressable target market will be used to determine your exit value. Because, and I'll explain to you how that discussion goes. Scalability. About 2 months ago, we were 2 days away from closing a deal with Yahoo for an asset we were selling. And most large companies do a simulation to ensure that the asset acquired will be able to scale within their arms. There is 2 parts to it. One is technical. Can the asset support 1 million transactions an hour, or whatever the number is? And how many additional personal resources, like human resources, do we need to support that? So it's both platform and resources to get to that number. The business model, we've discussed it, monetization mechanism. So this is a very important one. The market valuation parameters change regularly around your monetization mechanism. Monetization mechanism essentially means how do you charge your customer? So for a software company, are you selling them a license with maintenance, or are you charging a subscription fee? If you're charging a subscription fee, are you doing it per seat, per employee, per client, or is it a large subscription fee for a division, or how do you do it? Or are you charging services dollars? So to the dismay of some of my friends here, in the current market conditions, per employee subscription models are at the very high end. Services dollars are at the very low end. Services dollars are worth $0.5 to $1.2 per dollar. Subscription models for enterprise class software are worth upwards of $8 to $9 per dollar. Material difference. Competitiveness and defendability of the IP. So defendability of the IP means, can I get a couple of smart guys and a couple of $1 million and replace what you have in less than a year? Including your customers, not the technology. The technology is not as important, including your relationships. And valuation is obviously negotiated, so.
Can I ask, when you talk about multiples, and you mentioned earlier on something that was 7 times and then an EBITDA, whatever.
Yeah.
What is the highest? I mean, I'm in the payments side.
Yeah.
And we can talk about that later. But one of the reasons why I'm in it is because the comparable exit of very few players in that, because of the stickiness of the client base and the turnover and everything else, was in excess of 20 times.
When?
In the last 3 years.
Mobile ad networks sold for 8 times 3 years ago. Unfortunately, the life cycle of these valuations is relatively short. So churn, payment companies are divided into a number of segments. We are a huge investor in Payvia, which is one of the larger ones in the US. Silver Lake is in it for $65 million. They wish they could get the money back. So payment companies are very sector specific as far as who their target customers are and how they're charging it. Because it's not difficult setting up payment companies. The higher their growth rates and top-line revenues are, the higher the valuation. So there is definitely valuation expansion with size. So you do get a premium with size and the quality of customers. But churn becomes your key parameter. We are short on time, but this is what obviously investors go through. There's nothing there you haven't seen before. Let me see if there's anything else. For Jersey. So I put this slide together because everybody says, so what do you think we can do here? First and foremost, to be clear, if anybody says to you, how come we are not Silicon Valley? Tell them, if you want Silicon Valley, move there. This will never be Silicon Valley. I live in Los Angeles, a city of 15 million people. How many funds do you think we have in Los Angeles? Somebody give me an idea. Somebody that I haven't said already. Take a wild guess. 15 million people, how many funds are in Los Angeles? Please, not all at once. Nobody? 7. And 5 are sub-$100 million. Do you know how many there are in Silicon Valley? It's approaching 1,000. Los Angeles will never be Silicon Valley, nor will Jersey. But every community has its strengths, and you build on it. But you have to let it happen. I think the biggest problem I see here is hiring. I don't see any other problems. If you take the hiring issue, if you solve the hiring issue, I don't really see any other problems at all. So if you look at, we have played so has anybody here heard the term Silicon Beach? That's what we term Santa Monica, and it actually happened in my office, and we built it for the past 5 years into what it is right now. We are also very involved in Singapore. So we have the biggest incubator in Singapore, and we're doing the same thing there. Every community is different. You have to take advantage of what's going on there. So right now in Singapore, they have focused on mobile technologies. You can use your phone to do just about anything, from dating to paying for the date or paying for food, everything you can imagine. What is it that we can do here? First of all, we need to manage expectations. It is a marathon and not a sprint. If anybody has expectations that tomorrow things are going to be different, that will not be the case. There will be blimps along the way. A lot of companies will fail, but you keep at it until it works. The entrepreneurs that fail once will succeed the next time. It is normal. There is nothing wrong with a company going under. Investors are used to it. My first 5 investments, God, I don't even know where the hell they are. So it's okay. Let the community work itself out. But it takes time. But the strength here is enormous. And I say that is because sometimes when I meet with people here, they all say, well, we want to be this and that, the other. No, we are what we are. And it is what it is. You have to build on it and be patient. Any questions on that? I was mentioning it to Paul. My personal feeling is exactly what happened in Palo Alto and exactly what happened in Los Angeles is likely to happen here. One company in Los Angeles is responsible for the vast majority of the ecosystem there, and it was MySpace. When MySpace sold, it was bought by Ross, who was at the time a very good friend of mine, who became the CEO of Yahoo and now is running Guggenheim Digital. The founders included Richard Rosenblatt, who is now running Demand Media. He was just fired last week, but he built Demand Media. It was Josh, who has built another company called Beachmint. It was about 6 other guys. I don't want to name all of them. They all went off and built a whole bunch of other companies. But the best example is PayPal. PayPal is responsible for everything from Square to YouTube to any other number of companies you see in Silicon Valley. One exit we will see will have more effect on this than anything else you can imagine. Questions? Opportunities. Well, you know how good you are. And that's the conclusion. But I know we are out of time. I want to thank you again for your time. I'm sorry I can be annoying sometimes, but if you have any questions, I would be happy to address them. All right, that means I have to figure this out. Hang on. Is that it? All right. I go to Israel a lot. And when Israel first started, the joke was 20, 30, 40 years in Israel, they couldn't build a bicycle. Look where they are now. This is different. You have significant levels of education, not necessarily in coding, but a highly educated community. You have a very, very strong infrastructure. You can be a hub to Europe. Most companies, and I'll talk about e-commerce because I know the exact numbers, that tried to go directly to Europe failed for an e-commerce standpoint. So as a hub to Europe, as an intermediary or as a stepping stone to Europe, this could be a very interesting idea. And this is a tax-free zone. I mean, I could figure out a lot of ways to make this interesting, but there's one more aspect. The first thought that I had when we were first discussing this is companies that build technologies that are portable would be very, very appropriate here. Because it's a very interesting place to build it, test it, and then scale it. And I am very personally against pushing a sector. We've had this discussion, but everybody knows my views. I think we need to create an environment where people decide what companies they want to build. We should enable them to do it, but let them build companies that they can scale. Because if the company stays small, the buyer set will not look at it. If the buyer set cannot scale it, they will not look at it. But if they can take the asset and scale it Europe-wide or globally, buyers will show up. I use the example, you put a cake atop of the 20th floor of a building and the ants still find it. It's kind of like that. I mean, good companies will be found and bought very quickly. Any company that sells software to financial services is always sought after. Not services, software. Because if you are able to sell it to the BOAs of the world and HSBCs, I could sell it to anyone else. I don't know if that answers your questions, but that's my assessment. This is actually a much better environment than Los Angeles, believe it or not. The reason is a handshake means something here. In LA, everybody wants to be famous and wants to be rich, and you're only nice to me as long as you think I'm going to make you one or the other. So there's no honor. I hate to say it, but you get disappointed over and over and over again. I think you have a degree of seriousness here that is very suitable.
Ivan, what draws you personally to Jersey? Somebody pick up the phone.
Paul.
What brings you here, and what makes you? What are you interested in? Why are you interested in Little Island off the coast of France? Given your vast experience and all the stuff you do.
In Singapore, and obviously we spent time there, they are unwilling to take risks. They are so unwilling to take risks that you don't know where it's going to go. And the amount of money they have put into it is magnificent. So when we first had our conversations here, I thought to myself, if indeed I am able to do even this much to creating an ecosystem here, after I've done it in LA, I'm a very happy man.
Personal challenge.
Well, I don't see personal challenge because everything is a challenge, but it's gratification. It would be phenomenal. It's funny because when I first told my wife I'm going to go to Jersey, she said, "Oh yeah, we used to go there for vacation." I'm like, "You're from Beverly Hills. What do you mean?" No, I think it would be phenomenal to build it, and I think results matter. I also have no illusions about how long it will take, and I will repeat that over and over again because you cannot rush this. Mistakes will happen. Companies will go under, but over the long run, it will be built.
That's what 3 barriers do you think there are to success here that would be ideally removed or would speed up the ecosystem?
The first one is hiring. I mean, it is incredible how mobile entrepreneurs are. And they will dig up where they can go, where the best opportunities are. But if they can't get in, they can't get in. That's number one. Number two is capital. We do not have an ecosystem that supports entrepreneurship from the beginning to the end. Yesterday we had a similar conversation to this and I drew it out, and we need to have a fully supported incubator. We need to pool together the angel investors in an early stage fund. We need to have growth capital, and we need to hold their hands all the way through. We need to do the first batch together to see success for the first 10 or 20 or 30, get them to exit, then they will do the rest for everybody else. It has to be done in that level because I think the mistakes will be made. They haven't done it before. They don't know. They don't know what buyer to call. They don't know how to raise money. But we've done it many times. It's not brain surgery. We know to call. So let's hold their hand, take them to exit. Then we expect them to do that for others. Other than that, no. I think politics in Ireland are a little too much for the size of it, but heck, I'm from Los Angeles. There's politics everywhere.
How many companies make it from that seed stage to that early stage?
It depends on who you ask. Because we don't know how many companies are seeded from, I can tell you about where we're invested. Amplify, over 90%. Science, 95%. But man, it's hard to get in. I mean, we can be ruthless in the selection, selection is not about hitting them over the head. It's making sure they understand the expectations and that they actually prepare. You don't want them to wing it. You don't want them to say, oh, well, it's money, we'll figure out what to do. No. Discipline. For most early stage funds, you will find actually, for most angel investors, individual investors, the track record is quite poor. For professionally managed early stage funds, it's really high. The returns can be solid. Questions? Well, thank you all.
You spoke about politics, so I'll put a political question. I'm lobbied a lot about, and currently in the run-up to our budget here, there's been quite a lot of discussion about the importance of tax credits or tax offsets. There's lots of talk about the UK scheme that has been put in place to allow investment into tech companies, etc. I came following to why I wanted to come and listen to you this evening was just to sort of kick the tires of this issue. What is the relevance of tax incentives in the whole debate about how you get money to tech businesses? And how
I'm glad you brought it up. From the entrepreneur standpoint, not much. From an investor standpoint, extremely high. As an investor, ideally, I would like to do what they do in Israel. I want to write off my investment as soon as I invest in a company. And if I have capital gains on the other end, I'll pay it. I want it to that extent. In other words, I want every tax benefit for risking my money into these companies. So it doesn't impact the entrepreneurs except for the investment up front or throughout the stages as you go. I think from that standpoint, it makes a lot of difference. Unfortunately, in the US, they're making it harder and harder and more expensive. Other countries, they're making it much more available. So the tax incentive is to the investors. And I would extend that to say, if you're investing directly or indirectly, in other words, if you're going to be an LP in a fund, you should be able to get the tax benefits for that.